world-renowned trader, advisor, and entrepreneur, is back at the show after a 7-year hiatus, representing a rare opportunity to meet one of the most sought-after speakers and teachers on the subject of trading the financial markets for a living. In 1999, Dow Jones dubbed him the Messiah of trading. Oliver, thank you once again for your patience, and thank you so much for joining us today.
Well, thank you for having me once again, and let's get right into things, guys. Traders, welcome to another very special Money Show presentation, and of course, specifically welcome to another one of my specific presentations for the Money Show. I want to give a lot of thanks to the Money Show for having me a variety of times over this current year. It's been wonderful to return back. As mentioned, I've had somewhat of a hiatus doing these events due to my busy travel schedule international as a result of the world sort of not traveling now. I'm a little more settled in, and I'm very honored to be able to do these events for the Money Show once again. Today's presentation, traders, is on something that I think is extraordinarily timely for all market participants. We find ourselves in one of the most unique years in not only the world's history, but more specifically, we find ourselves in one of the most unique years from a financial point of view. Now, I'm going to talk today about why I believe and why you should believe that this year, 2020, is actually a repeat of the year 2000 all over again. Now, before the end of this presentation, or by the end of this presentation, it is my hope, it is my desire to convince you of the same thought, the same belief, the same concept. And so let's delve right into things, but just for the benefit of those individuals watching this either now live or sometime in the future on the internet, you have no idea who I am. Very quickly, my name is Oliver Velez, of course, and I'm a pioneer of the trading, the modern day trading industry, if you will. I placed my first trade all the way back in 1981, a long time ago. I became a professional trader on December 6th of 1986, becoming a Wall Street trader. After about eight and a half years of trading on the street, I decided to actually take a bold step by leaving Wall Street and starting my own independent firm, a firm that actually catered its services to other Wall Street firms. I founded that company called Pristine. A lot of people know that company today as Pristine.com in September of 1994. And over a 12-year period, I grew that company into an international powerhouse. We became one of the largest financial training organizations in the entire industry, and if not in the entire world. Throughout those years, I was known as the father of swing trading. That's right, I coined the term swing trading all the way back in 1994, and really spent a lot of time bringing a lot of attention to that new style of market play, which I dubbed swing trading. All you have to do is Google that, Oliver Velez swing trading, and you'll see a lot of my past work in making sure that name caught and that style of market play became an integral part of the financial landscape. Barron's in the year 1998 ranked my training services for professional traders #1 in the entire industry. Dow Jones in 1999 dubbed me the Messiah of trading, and I was chosen by this organization in 1999 to be their very first inaugural keynote speaker. I was chosen to be the face of the industry and to represent the industry as a whole. I was also granted that honor once again the following year in 2000, and the third time this year in 2020. I am the author of 5 international best-selling books on the topic of trading the markets for a living. These books, traders, actually are written in 5 different languages: English, Spanish, we have Mandarin, German, and Japanese. So 5 distinct languages, and they continue to be some of the most bought trading books in the entire industry. I have today over 10,000 traders in over 92 different countries that are under my tutelage, my mentorship, many of whom actually trade my personal capital. I continue to advise and speak for financial organizations globally. So that's me and my history in a nutshell. This is one of the first articles of me delivering my keynote speech for the industry in 1999. This is the article in which Barron's ranked my work #1 in the entire United States. This is an image of at least some of the books that I've written in multiple different languages on the topic of trading the markets for a living. That was a schedule of mine this year, which obviously got canceled. And traders, before we delve into the meat of the matter today, I really would love for you to follow me on the following networks. Instagram, I am active virtually all day long, delivering motivation, trading concepts, tips, and information. Please follow me there. And if you're looking for one of the most informative, one of the most educational trading channels on YouTube, follow me at Oliver Velez Trading. This content comes out 365 days a year, traders. So 365 days a year, you are given something that will raise your level of market sophistication in the markets every single day of the year. And I'm proud to announce in 3 different languages: English, Spanish, and Portuguese. Okay, now let's talk about why I believe that this year, 2020, is a replica of the year 2000, and why that's important for you to know. Because if we know what happened, if I'm right, #1, and if 2020 is in fact the year 2000, repeating all over again, and we know what happened in the year 2000, then that would go without being said that we can sort of get ahead of the curve and know what should happen in the very, very near future, if in fact I'm right. And it is my job over the next 20 minutes or so to make sure that I convince you that I am right. Okay. Now, the things that we're going to need 4 specific items. We're going to grab a monthly chart of the NASDAQ specifically. Now, why the NASDAQ? Because the NASDAQ is the driving force behind the world's markets today. All right, so we're going to focus on the leading market. We're going to focus on the leading index. NASDAQ is ahead of all the markets. NASDAQ is driving the bull right now. You always focus on the driver. NASDAQ's the driver. So we're going to take a monthly chart of the NASDAQ. We're going to overlay a 20-period simple moving average on that monthly chart, okay? I have found no evidence in 33 years of professional play that the sexier varieties of moving averages work in a more superior way than the simple. So I keep it simple. Okay, 20-period simple moving average overlaid on that monthly chart. We're going to also utilize, in a small way, the 50-period simple moving average. I'll explain how we're going to use that moving average. And of course, we're going to utilize the granddaddy of all moving averages, the 200-period simple moving average. All 3 of these moving averages are simple in nature, not exponential, not triangular, not weighted, none of the fancy versions. Simple will do, okay? Now, we're going to take a monthly chart of the NASDAQ. We're going to take the NASDAQ 100 in particular, because if the NASDAQ is the heart of the market's bull today, we want to get into the heart of that market, and the top 100 stocks driving everything are in this index, the NASDAQ 100. This is taken as of today. So you're looking at a very current monthly chart of the NASDAQ. Each bar represents 1 full month of trading, with the exception of the current month. The current bar, or the rightmost green bar that you see, is the month of August. So we still have a couple of weeks left in August to go, but every other bar is an entire complete month. Of course, the red bars represent months that actually closed lower than where they started the month, and all the green bars represent months in which, or during which, the index closed higher than the month began. Okay, we're going to overlay a simple 20-period moving average on this monthly chart. Now, notice how beautifully this moving average tracks the overall activity of the monthly chart. I want you to notice those periods during which the NASDAQ sort of brushed up or leaned against the 20-period moving average, breaking it mildly, which we don't even really call a break. I want you to take note of these sections. Let me just denote them for you, okay? I want you to note these little sections here, these little periods where there was a mild violation, for lack of a better word, of the moving average. Now, I don't want you to look at those as actual breaks of the 20-period moving average. I want you to review or regard the 20-period moving average more as a fence that you can lean against, a fence that has leeway, or a rubber band that can bend but not necessarily break. I want you to think of the 20-period moving average as if they were boxing rings where boxers can lean against the ropes but not necessarily break the ropes. So these moments where you see these circles, these are moments where the NASDAQ leaned against the ropes, leaned against the 20-period moving average without really snapping the 20-period moving average. Now, a lean is no more than 1 or 2 bar violation. So a 1 or 2 bar lean and boom, snap back. A 1 or 2 bar lean, boom, snap back. A 1 or 2 bar lean, boom, snap back. Okay, when we get into 3 and 4, that's when we sort of are dealing with a break and not a lean. You have to be able to determine what's the difference between the index or a stock leaning against its moving average versus breaking its moving average. So 1 to 2 bar snapback is lean, 3-4 bar is break. Remember that rule, extraordinarily important. Okay. Now, we've got the 20 on there. Here's the 50-period moving average. Now, I love the 50-period moving average used in conjunction with the 20-period moving average when it comes to really trying to buy into oversold markets. So if you look over the past 5-6 years or so on the NASDAQ, each time that the NASDAQ slipped between its 20-period moving average and that 50-period moving average, it sort of represented a very unique, interesting buy opportunity. We slipped between the 20 and the 50-period moving average right into the latter part of 2018, an interesting buy opportunity. We slip in between the 20-period moving average and the 50-period moving average with the coronavirus collapse, right? In a March of this year, boom, an interesting buy opportunity. So we look at this space between the 20 and 40 period moving average, as long as the 20 and 50 period moving average, as I say, as long as both of those are rising, as this sort of buy cushion, this buy zone, this unique opportunity to look for value in a long-term uptrending rising market. We want to use these two key moving averages, the 20 and the 50, to get that buy zone. Now, usually in that zone, traders, usually in that zone, everything is negative. Everyone's scared. Everyone's fearful. All the news topics are negative. There's blood in the streets. There's fear in the financial markets. But you've got to look at things technically to step outside of that emotional cycle. Okay, so when we drop into this range, one, as long as both of those moving averages are rising, one should actually flip their mindset to actually a get in mindset, a buy mindset, not the fearful mindset that will certainly be propagated during that time. Okay. So we've got the 20 period moving average, we've got the 50 period moving average, right? Now, I want to put the 200 period moving average. As I mentioned earlier, this is the granddaddy of all moving average traders, all moving averages. This is the one that virtually every single person, every single market participant on planet Earth actually follows this moving average. So because of that, it has a huge self-fulfilling prophecy element to it or characteristic to it. okay? So we have all three moving averages on the chart. Now, the 50 is only utilized to find the buy zone in a long-term uptrend. That's the only purpose it has, as I've explained. For what we're going to go into now, it does not have a purpose. So I will drop the 50. Now that you know why we use the 50, we're going to remove the 50 from the equation to talk about the reasons why I believe the market today is mimicking the market all the way back in 2000, which I lived through and profited from in a huge, huge way. And I'm hoping this repeats itself. In fact, I'm willing to bet it repeats itself. Okay, now let's talk about my space concept. Now, many of you who've been following my work, you know my space concept. It is something that I pound the table on. It is something that I make sure every single one of my traders understands intimately. Understand this concept, and it will be very difficult for you to really find yourself on the wrong side of the market long periods of time. It's not that this is going to save you from ever being wrong in your life, but for long periods of time, it's virtually impossible to be on the wrong side of the market for any extended period of time if you follow this space concept. Now, what exactly is this space concept? What do we need? To follow my space concept, you need three things, traders. You need the actual stock or index itself, or whatever it is you're trading. This is applicable on anything: options, bonds, futures, currencies, cryptocurrencies, cabbage patch dolls, pet rocks, whatever it is that human beings trade back and forth, it doesn't matter. This is universally applicable, okay? So you've got the item that you're trading or looking at. In this case, we're looking at the NASDAQ 100. You've got the 20-period moving average, right? You've got the item, the 20-period moving average, and you've got the 200. Remember, we don't need the 50-period moving average for this concept, okay? Now, we've got the three items that we need. Now, check this out. This is very, very fascinating. I want you to go all the way to the left of the chart, and I want you to take those three items and notice the state that the three items are all the way back in 2010. Now look at, I put circles, 3 circles, you see. I put 3 circles, each one circling one of the 3 items. I've circled the actual NASDAQ 100, I've circled the actual 20-period moving average, and I've circled the actual 200-period moving average. That's 3 circles right there. Now, I want you to now go over to the right-hand side of the chart. And let's circle those 3 items again, which you see here. I'm circling the NASDAQ 100 itself. I'm now circling the 20-period moving average, and now I'm circling the 200-period moving average. Now, compare the 2 states. Let's go back 10 years from today, 10 years from today, okay? Or more or less from today. And look at the 3 circles 10 years ago. Now, look at the 3 circles today, okay? So obviously on the far left-hand side of the chart, we are in what is called a narrow state. What the state that we're in terms of the market now is a wide state. And what you have to understand is that all markets do, irrespective of the market, all markets throughout the human world, okay? Human beings trade back and forth. They vacillate between 2 states, narrow state, wide state. From wide state, we go back to narrow. From narrow, we go to wide. From wide, we go back to narrow. That's all the markets do. We rise wide and we fall. We shrink. We widen and we shrink. We widen and we shrink. That's all markets do. And what you have to do is to be able to determine which one of those 2 states am I in? Well, in reality, we have 3 states. You've got the narrow state, you've got the wide state, and you've got the middle state, right? So in essence, you've got this. You've got narrow states that cover a period, and you've got wide states that cover a period, and then you have the middle. All right. Now, the minor states are always narrow and wide. The biggest state of all, well, I didn't realize that can go down like that. The biggest state of all is always the middle. It's sort of like the middle class in the United States, right? That class is the biggest. The poor is a small group, relatively small. The rich is a small group in number, but the middle class is the biggest. Same thing in the overall market, right? The narrow state, poor, okay? The wide state, rich, two smaller periods of time, but the middle is where the vast majority of the market spends its life. But you have to know, be able to determine, am I in the poor, narrow state? Am I in the rich, wide state? Okay? Or am I in between these states? Is it not quite so narrow, but not so wide either? And this knowledge, this simple ability can give you a clearer indication of what you should be doing and how you should be playing. Now, the very best time to start aggressively accumulating new positions from a long-term perspective is in the poor, narrow state. The best time to think about taking profits off the table, going more to cash or going more to other assets that are not in a wide state, okay, is when you are in that rich wide state. The time that you can pick and choose and get into some things and so forth and so on, but the time to really ride and relax and not be so anxious is in the middle state. Okay, so knowing these three states is crucial, absolutely paramount to knowing how to structure your overall approach to the markets. And if you don't have any idea what state you're in, you are bound to make some of the silliest, some of the most novice related decisions. Okay, now let's continue. Wide state, narrow state, wide state. Now, notice how wide state doesn't, we have the narrowest state is here, right? But this, it's relative. This is still pretty narrow. This is still pretty narrow. Notice how your narrow state lasts for several years. Notice how your middle state lasts for several years, and your wide state can last for a time as well. It's not pinpoint. Your wide state can last for a year, year and a half, maybe 2 years, but always the middle is the fattest, is the longest in duration. Always, always. Okay. Now, let's continue. Let's talk about the same concept through the eyes of, or from a different angle. Markets breathe. So sometimes I explain this as space and sometimes I explain this as breathe, and I'll breeze through this, no pun intended, okay? Look, we've got 20-period moving average in the 200. Notice on the left, narrow state. Notice on the right, they separate far apart. The market in a narrow state is when the market is inhaling. And then on the wide state, it's when the market is exhaling. That's all the markets do. Inhale, narrow state. Exhale, wide state, and everything in between. But from an exhale state, we go back to an inhale state. It's just the way things happen. If you throw a ball up hard enough above you, right? First, it's narrow, it's close to you. You throw it up, and the space between you and the ball separates until at a certain point, the ball reaches its apex, and then it must come back down to get closer to you again, a narrow state. You throw it back up, wide, reaches its apex, and then boom, the ball falls and gets close to you again. It's just natural physics. The markets are subject to physics as well, okay? So once we get that exhale state, there is a point where exhale must lead to inhale, the narrow state. Natural physics. Now you got it? Okay, that's the crux of what I need you to understand at this point. May I go entender? Okay? Okay, let's go. Let's take a look at the past now that you understand this concept. Let's take a look at the year 2000. okay? I want to go back to 1995. We'll go back to 1995 now. I started my company in September of 1994. So I was just getting started on my own. I wasn't working for another firm anymore. I wasn't trading anyone else's capital. It's me, all me, nervous, young, but raring to go. And I started at such a wonderful time because why? I started from a narrow state. It's a beautiful thing, okay? Narrow state, those three items in the NASDAQ close, relatively close together, boom! And look at what happens over a 10-year period. So actually from 1990 all the way to 2000, we had the NASDAQ 100, the same index we're talking about, move from a narrow state to this whoppingly wide state. Look at how wide the stock is, or the NASDAQ is from the 20, and the 20 is from the 200. That was 2000, and that was the apex of, some of you understand this and know this and remember this, the apex of the dot-com bubble, the internet bubble, okay? Now, I want you to understand that there is a very prevalent 10-year cycle that runs through the NASDAQ, okay? Now take a look at this. Look at back in 1990. Look at 1990, all right? I have it here. Let's take a look. Here's 1990, narrow state. That narrow state lasted a few years, okay? Now, look at 2000. 10-year cycle. We go from narrow, 1990, to wide, 2000. Now, get this. This is really fascinating. The hairs on the back of your neck are going to rise now. Check this out. Now, from 2000, we drop all the way back to the 200 period moving average in mid to late 2002. So from the peak in 2000, we drop all the way back to start producing another narrow state into 2002, 2003. Now, here's what's interesting about this drop. Typically, from a wide state, the first drop, the first serious collapse is not the real major one. It's usually the second one. Statistically, going back over 200 years of, actually even longer than that, hundreds of years of studying the history of bubbles, okay? The first crack is usually not the main one. Look at the NASDAQ's first crack. Boom. Now that scared the market, okay? You see that? Now, look at that first drop. Boom. But then look at the rebound. And it was the second drop that did the market in. The second one is the big one. The second one is the big one. I'm going to say that 2 more times. The second one is the big one. One more time. The second drop is the one you have to really be careful of, not the first one. Remember this. Now, let's go back. Remember the 10-year cycle we're talking about, right? Let's look at the market today, the NASDAQ today. Let's go back. Here's that 10-year. First, we were talking about a narrow state in 1990. That narrow state goes to a wide state in 2000. From that 2000 peak, we drop, okay, with some fluttering around all the way back to 2009, 2010. A narrow state again. There's that 10-year cycle again. 1990, narrow. 2000, wide. 2010, narrow. 10 years later. 10 years later. From 2010, 10 years later, wide state. 1990, narrow state. 2000, wide state. Wide state 2000, 10 years later, 2010 narrow state. 2010 narrow state, 10 years later, 2020 wide state. Now, notice that the width is not quite as wide from the stock's point of view to the 20. This to me tells me we could see some higher prices. But what's my guess? Late October, November. You got to give me a 3-month period. October, November, December. Maybe with some spillage over into January, maybe. But let's watch that period, traders. Let's be prepared for it. I'm going to make sure that every single one of my traders, my wealth traders, are prepared for this. Not just prepared for it. We're going to milk this thing the same way that we milked it all the way back in 2000. This is a huge opportunity. Knowing the state can help you get prepared, to help you get ahead of what is likely to happen from a probability standpoint. I'm going to make sure that my traders are ready and prepared.
Hey, Oliver, we
Wide
are
state.
right at time, by the way.
All right, fantastic. 2 more minutes and I'll be gone. Now, what do you think is next? So you've heard what I have to say about it. I'd like to hear what you have to say about it. All right, you let me know. You let me know whether or not this connected with you, whether you have issues with it. I want to hear all of your opinions. Now, guys, look, if you want to be a part of my wealth trading program, I've got 400, almost 500 traders that were with me in the during the narrow state in 2010. We killed the market from this narrow state, killed it with things like Apple and Microsoft and Nvidia and Home Depot and McDonald's, and it was just crazy getting in to things during that narrow state. But now we find ourselves at a wide state. There are ways to profit from the wide state all the way back to narrow. We find ourselves not in the 2010 period. We're now in the opposite end of the spectrum. This also is another huge opportunity. So now it's time for phase 2 for us. You can join us. It's $4,000, guys. You can lose that in one trade. This is for life, for life. This program is for life. Now, for 48 hours, you have it for $2,000. You understand and get every single move I make in the markets. You play those moves with me if you decide to do so. Every single act I do, every single buy, every single sell, we meet several times every single quarter to go over the markets, to get our plays lined up. I tell you what I'm doing before I do it, why I'm doing it. You not only grow educationally from my views on the wealth side, but we play them together. We're in this thing together, guys. So if you happen to be interested in that, that's fine. If not, that's fine as well. Follow me on my YouTube channel. Again, I put out a piece of daily content every single day to raise your level of market sophistication. Thank you so very much for having me. Thank you, MoneyShow, for inviting me once again. I'll be back if you invite me again. I will be here tomorrow, same time, hopefully without the technical difficulties. And we're going to talk tomorrow at 4:40 Eastern Time, that's New York time, about another fascinating topic: how to short the market, how to sell short like a pro. So wonder why I want to teach you how to short? Wide state, wide state. Let's go. I'll see you tomorrow.
Thank you so much, Oliver. And I was just going to mention that he is back tomorrow. And as well, he also has a booth in the virtual hall. And after this presentation, if you want to continue the Q&A, there will be a chat box there for you. So I believe Nakoma, one of your employees, is in there right now.
Fantastic.
So
Thank you.
awesome. Thank you so much. Have a good one.
Thank you. Ciao.
Bye.